Overall has been trading somewhat sideways during the past few years. It has rallied lately. Many investors remain underweight in oil and gas since the COVID lows. Our guest says there is opportunity here for growth in hydrocarbon producers. We're joined by David Szybunka, a senior portfolio manager and managing director on the energy team at Canoe Financial. David, thanks very much for coming on the show.
Hey, no problem. Always good coming on.
You have one illustration for us. You says if we look at the weighting of energy, for example, in the S&P 500, it has come down significantly.
Yeah, you got it. I mean, while we look at commodity cycles, these cycles tend to take 10 to 15 years to play out. We think we're in year 4 or so of the energy cycle. But as you think through kind of back to spring of 2022, Russia invades Ukraine, inflation peaked out at 9%. Since that time, the sector as a whole has been going sideways. And so as it's been going sideways, other sectors have been going up. And to your point, energy weight in the market is all the way down to 3%. So investors feel like energy hasn't been working. If you've been in certain areas, it has. But the sector as a whole has been going sideways. And it's just been causing investors to feel like, well, this sector hasn't worked. The commodity cycle must be over. It's just not the case. And most people today are looking down, not up.
You believe that there's new life in the sector, partly because of optimism, for example, over LNG demand globally?
Yeah, I think something that is noteworthy to kind of talk to investors about, like there's lots of headlines on tariffs, geopolitical risk, all these types of things. To bring things back to full circle, what ends a commodity cycle is a capital spending cycle. When investors start to embrace capital spending, it's because prices are going up. Investors are seeing elevated geopolitical risk. All of this in a mixture makes investors feel like, oh my God, we should be investing more. When I go to conferences today, everyone just wants shareholder returns, dividends, buybacks. They don't want growth. Mm-hmm. And so it's interesting looking at the other side of the equation of what ends any cyclical sector cycle is a capital spending cycle. And we're seeing investors embrace that today in big AI and tech. All these companies are talking about, I'm going to spend 50 billion, the next guy 75, the next guy 100 billion, and investors are going, of course, we should be spending more. So it's the start of the end. But as we try and pair these two things together, you're going to need a lot of energy for an energy AI build out. And we keep talking to our investors about that. We're still seeing more of these things get announced. Yesterday, Energy Transfer did a deal with Cloudburst. And when you think about the tech sector, investors like growth in tech. No one's investing in Meta or these other areas, Oracle, because of their free cash flow yield. Yet when you go to energy conferences, all anyone asks about is what's your free cash flow yield? They don't want the company to invest. You're gonna need to pair these up at some point. You're gonna need the energy, and people are trying to treat them separately, and they're not, and they're embracing one area of the market, and they're not embracing the other. That's the opportunity that we see laying out over time.
Yeah, it is kind of interesting, isn't it? We talk a lot about apps and AI and large language models, but we forget that our society still needs a lot of good oil and gas and steel to keep running.
You got it. Like when we just try, again, I spent the last week on the road out east. We are still educating people on this. I keep getting asked about oil. It's about energy. The world's consuming 300 million barrels a day of energy equivalent each and every day. And this, for the last 20 years, has gone up by average 5 million barrels a day of energy equivalent each and every year. We think this is inflecting to 6 to 9 million barrels a day of energy equivalent. So energy is a very investable theme. Other sectors in the market, though, have been working. Our base case is over time, other sectors will quit working. Commodity cycles drive other sectors to have compression in their valuations because it's like putting a tax on these other sectors. If this plays out over time, investors will begin to embrace it. On the year, I would just say also what we're seeing is we're seeing a broadening out of commodities, right? The breadth of commodities has actually been getting better over the last 2, 3, 4 months. Global PMIs are doing better. US has been doing better. The globe's been doing better. Gold led, then copper, now all of a sudden natural gas. The broadening of commodities has actually been quite good, but no one's really embracing it. If this keeps going, inflation expectations keep going higher, energy is actually the hedge in people's portfolios, and they've actually been selling it or taking weights down because they're worried about energy. They should actually be taking them up.
Is there a risk that American companies do go for the so-called drill, baby, drill and flood the market?
I get asked about this almost every single presentation, and I would just say there's no such thing as drill, baby, drill. There's oligopolies forming in the sector, larger and larger companies, massive M&A has been going on the last 24 months. Management teams and board back in 2014, where there was hundreds of companies, no discipline. Management and board got paid more if they grew more. Today, management and boards get paid more if they have more shareholder returns. And so we're not just going to see these companies go and drill, baby, drill. But what I would say is, as we look at energy policy south of the border, it's going to be build, baby, build. And when we look at all the red tape that's been happening up in Canada, there's a lot of red tape down in the US. When we look at the average age of the grid down in the US, it's 40 to 50 years old. So they haven't been able to build more transmission. 13 years ago, the average transmission was 4,500 miles a year. The last 2 years is 500 miles. Trump and Chris Wright from the US are going to rip the red tape off, have the AI side of the US. They're in an arms race globally with big tech, and they're going to source this power within America and fund it with an American energy and build, baby, build. And if they have extra energy, they're going to export that energy to the globe, and it's going to be America first, energy independence. And so this all in a mixture is really good for energy, right? This is what people are missing.